All right, it's time to talk about the second strategy in the portfolio, which is the VIX strategy. Let's start off by just taking a look at the key metrics for this strategy. As you can see, this one has a little bit more volatility than the ETF strategy, but it also has an astronomically higher compound annual growth rate, right? The ETF one was 5.5%. This one is sitting at 11.73%. And when you add these two numbers together, you can kind of see, since we're using margin to trade both of them at the same time, you can kind of see how we're getting up to that number of around 18% compound annual growth rate. The max drawdown for the VIX strategy is also higher at minus 19%. And the reason why you don't just see these two strategies completely stack on top of each other in terms of the max drawdown is because they don't necessarily lose money at the same time. One of the beauties of this portfolio is that not everything is one-to-one correlated. Amongst the different ETFs we're trading and the two strategies we're trading, there is of course some relationship, but it is not a perfect relationship. And that allows us to have this whole make money in different regimes thing going on. So why does this VIX strategy make money? Well, if you have an understanding of volatility trading, so if you come from an options background, for example, then you'll already know this. But if you don't, the idea is basically similar to insurance. You see, when people hold a bunch of stock, like a hedge fund or a pension fund holds a bunch of stock, they don't necessarily want to keep taking the downside risk that the equities market could crash. So what they do is they go out and they pay a bit of money to buy options or to buy protection against markets becoming more volatile. The VIX is the index that tracks this market fear, you can think of, or the level of expected volatility in the market. And historically, what's been observed is that the level of fear or implied volatility is typically higher than how much actualized or realized volatility ends up occurring. And the difference between the two can be monetized because there are products that trade given the level of the implied and then become valued in the future at whatever the realized is. Entire hedge funds and careers are built off of trading this concept called volatility. And that is the first and primary driver of what makes this VIX strategy profitable. We are short VXX, which is one of the instruments that gives us exposure to the VIX futures contracts. Now, the second effect that we are leveraging as a part of this strategy is actually this VIX futures curve roll down. So the way you can think about it is we're not actually trading VIX, we're trading the VIX futures contracts. And when VIX is in contango, which is where the futures contracts are valued higher than the spot price, as time passes, they roll down towards the spot price, meaning the contracts that we are exposed to through short VXX slowly decay in value, and therefore VXX also slowly decays in value. Exposure to this is a second reason that this strategy is profitable. Now, there's a third and final reason that this strategy is just an absolutely amazing one to include in this portfolio, and that is this market timing component. You see, with this strategy, if we were just short VXX all the time, the times when we would make money are when things are really calm. But the times that we would lose really large sums of money would be when things get a little crazy. During market crashes, times of severe uncertainty, that is when you start to see a little bit of pain when you're short VXX. So what do we have embedded into this strategy? We have a timing mechanism that uses a function of the VIX curve to signal to us whether future implied volatility should continue to rise or if it's going to come back down. And that signal that we primarily use is called the shape of the VIX term structure. If the VIX curve or term structure is in contango, which means as they go further out in time, they're implying more volatility, then we are going to be short VXX. But if it flips, and now we're saying in the short term, there's going to be more volatility than in the long term, meaning things are crazy now and going to calm down later, then we move to either cash or even flip into a long VXX position. Now I'm going to pause there for a second because that is kind of a lot of information. And I want to point out that you should generally understand this stuff as a part of running this portfolio, but you don't need to calculate things on your own. You don't even need to really deeply understand the math behind it. It would just be good to know that you understand what's driving returns in your portfolio. Once again, my honest recommendation is to talk to ChatGPT about it. If you're not familiar with these concepts, get familiar. It'll take you 5 minutes with a conversation with ChatGPT. And after you do that, if you still have questions and you want me to help you, leave a comment on the video or reach out to me if you're a member through the in-app chat, or book that welcome call with me. There's lots of ways to get support. Long story short, with this VIX strategy, there are 3 states that you end up in, like 3 positions that you could be trading. You could be short VXX, you could be cash, or you could be long VXX. And which one you're in is basically determined by a bunch of math that we do in the system. All of this math is covered in the research document that's available on the top of our website. If you just click research, it pulls up the whole research paper and you can see how all the signals are calculated there. And then on top of that, we do a bit more math to figure out how much of our capital we're going to be allocating at any given time. The most common way that it's done in the platform There's a few variations, but the most common is we look at the level of VIX and then we say that's the percentage of NAV that we're allocating to the strategy. So if VIX is currently at 15 and we have $10,000 in the account, our NAV is 10,000. We say 15% of 10,000 is 1,500, and we would use $1,500 worth of short VXX or long VXX, depending on the signals, as the position that we are in. That's literally it. We figure out if we're short, cash, or long, and how big we're sizing it, and we place those trades. Now, you might be wondering, what percentage of the time are we short, cash, or long? Well, if you take a look at this chart here, you can see that 91.4% of the time we are short VXX, 6.6% of the time we are flat, meaning we are in cash, and 1.99% of the time, so just 2% of the time, are we long VXX. Now, with the ETF strategy, remember, there was a couple times that we needed to do a rebalancing or adjustment. And for this strategy, there are once again a couple of different times that we need to make a change. The first time that we need to make a change is if the allocation that we've made for VXX, let's say it's 15% right now, if it drifts plus or minus 4% from that, then we need to rebalance back to that number. So let's say it's supposed to be 15 right now, and we get up to 19% of our capital or NAV is in VXX, then it'll trigger a rebalancing, and we'll bring it back down to that 15 number. And likewise, if it goes down to, let's say, 11% or 10%, we're now more than 4 away from that 15 number. And so we're going to trigger a rebalancing and bring it back up. When these rebalancings are triggered, it literally will just send you an email. You go into the platform. It'll tell you exactly how many shares you need to be trading to get back to the ideal position. And then the second time that something is required from you and a trade needs to be placed is if there is a change in the signal, meaning a flip from long to short or cash, or there's actually one more as well, which is if the realized volatility is higher than the implied, but the term structure is still in contango, you go into a half-size position. So you take the VIX number and you divide it by 2, and that becomes the new way you allocate how much capital is in the trade. I want to say it again because this is a lot of math I'm throwing at you, and I totally understand that. For most of you that watch it and made it this far into the course, like, you should be buying the tool probably and just running this portfolio and enjoying all the free time it's going to give you and the compounding it'll give you in the long run. Don't get too caught up on the math. Do go back and watch it if you are planning to run this yourself. Like, I am explaining the numbers, and between this and the research paper, you can totally go do this yourself if you want to build it out yourself. But for those of you that plan on just using the tool to make your lives easy and streamlined, you need to remember that the math is being handled for you. That is why you have the tool. So at this point now, we've covered everything you need to know for the overall portfolio, the ETF strategy, and the VIX strategy. You should be able to see this portfolio in your mind. If you've read the research paper, you should have a really strong confidence that this is something that works, first of all, scales, second of all, and is implementable by you, third of all. And so what I want to do now is talk to you about what the first 30 to 90 days of doing this could look like.